Good afternoon, ladies and gentlemen, and welcome to the Downing Renewables and Infrastructure Trust PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab that's situated on the right-hand corner of your screen. Just please simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll email you when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Tom Williams. Good afternoon to you, sir.
Yeah, hi there, and thanks everybody. Thank you very much for joining. So, if it's okay with you guys, we'll get straight into the presentation. We're here to talk about Downing Renewable and Infrastructure Trust. People that you have with us today, I head the Energy and Infrastructure practice here at Downing. I also very pleased to have with me Tom Moore, who heads our asset management business, and Henrik Dahlström, who's an investment director in the business, focusing exclusively on the Nordic regions. Now, there are a few important notices. We would be very grateful if you could please read them in your own time. They do go on. And there's also a short summary of the key metrics of the fund here. So again, if you want to have a look at that, we'll probably not go through all of that just right today. So why are we here talking to you today? Well, we wanted to tell you a little bit about the performance of the fund to date, and to also talk to you about why we're out trying to raise some further capital for the fund to invest. So where are we today? We are 83% invested. We have been 83% invested since the 4th month of the fund. So that is ahead of our own targets for investing in the vehicle. We've invested in assets that have done better than expected. Generation is up, operating profit is up. That has led into NAV growth, and it has also meant that we've been able to pay a 1p dividend for the period to 30 June 21, and we've been able to increase our dividends guidance so that the 5p target starts from 1 July. So we had originally thought that it would take us about a year to invest the proceeds of the IPO, and that we would have to start that higher dividend later, 1 January next year. Been very fortunate to be able to bring that forward now, and target that 5p from 1 July this year. As we mentioned, we are seeking to raise further capital. Why is that? We have a very significant pipeline. You can see some stats there. It's some very big numbers involved. Those numbers are interesting. They're indicative of a much wider pipeline of possible opportunities. But what's really interesting is a shorter subset of that pipeline, around about 90 million or so, which is where we hope to invest some of the proceeds of this IPO. Talk a bit more about that later on. So just a quick reminder about Downing. We have been investing in core renewables for a long time. We've been doing that for about 11 years. We've made about 130 or so investments in the space in that time, in core renewables, wind, solar and hydro. We have exited around about half of them at some quite good returns, and we are currently holding the balance of the assets in a very similar return. We've got about 180 employees in Downing, with about 30 people who focus on energy and infrastructure, and we're very focused on responsible investment. We are an Article 9 SFDR fund. What does that mean? It means that we have a specific target, a specific investment objective, which is related to sustainability. So just a quick reminder on the strategy of the vehicle. We have diversification at the very heart of everything that we do. Why is that? It's for two reasons. One is it does broaden the pipeline and the scope of opportunities, and you can see that in the size of the pipeline that we're demonstrating to you. And second of all, it increased the stability of returns. How do we increase stability of returns? Well, it's all about looking at these things here. When you invest in any given technology, so a solar park or a wind farm, you are reliant on a given natural resource, the sun or the wind. Now, that resource is intermittent, it is variable, and so we prefer not to rely on any one resource, but we'd like to rely on a variety of those resources, reducing your dependence on any given natural resource. If you move geography, you can access different natural resources, and that's the case in our portfolio, where we have a significant investment in hydropower plants in Sweden. And where you invest in the same technology in different geographies, you can also achieve diversification because, for example, the wind doesn't always blow at the same time in Stockholm as it does in Surrey. You can also achieve diversification if you are investing in projects that sell their energy into different electricity markets with different fundamental drivers, and that's very much the case again between the UK and the Nordic regions. When you combine that diversification by technology, geography, and also project stage, you can achieve a diversified set of revenues. We do focus very much, when we think about that revenue, on merchant power price exposure, which in our view is one of the key risks in investing in this kind of these kinds of projects and this kind of a fund. And we'll talk to you again a little bit more about that later on. So why are we in front of you today specifically? It's to talk about a £25 million raise. We have a very clear idea about where we would like to invest that. We've got a considerable pipeline, and we've got a series of near-term opportunities. And we also talk to you here about the price of the issue, and we talk about the price relative to just before we launched the offer, and the premium that it is to NAV. So the placing does close on Wednesday. It is a short time, I'm afraid, for this one. It was not open for very long. But we do hope that will be sufficient time for you. Now, just to give you a quick update on the portfolio itself, we have hydropower plants in Sweden. Those are the 8 dots in blue on the right-hand side. We've got a well-diversified portfolio of solar in the UK. That's all the dots on the left-hand side. And if we go to that hydro portfolio, it's 8 hydropower plants located on 3 main river systems in Sweden, 2 Swedish price zones. Price zones are important in Sweden. There are 4 of them, and there are different prices in each price zone because there are constraints with the electricity flowing from one part of Sweden to the other. And those hydropower plants have been around for a long time. They've got a very long, very established track record. They've been operating for 60 to 80 years. So our belief that they will be operating for at least another 60 to 80 years. They're very, very long life assets. And given the size of the portfolio that we now own, we have been able to generate a number of attractive bolt-on opportunities of smaller portfolios to grow the portfolio. And those look very attractive and accretive. And in fact, there are 2 of those in the shorter pipeline, the subset of the pipeline that we have in exclusivity or in bilateral discussions that we'll talk to you about later on. The UK solar portfolio, again, nice established track record. I have to say, not something that is quite as long a track record as the hydropower plants. This is only 6 years versus about 60 to 80, but there are 50 companies, about 3,000 installations, and we have not only a very large a portion of the revenues that are that attract subsidies, but we also have quite significant fixed revenues on top of the subsidies through the contracts by which we sell the energy to the market. So what does that mean? It means that there's very significant protection against negative power price movements in the future. What does the portfolio look like today? We have the technology split there on the left-hand side. You can see the solar and the hydro splits. We sell into 3 principal power markets. So Sweden, the GB, and the single electricity market, which is the unified Irish market. And at the moment, we have 0 construction exposure. The portfolio is entirely operational. I said at the top of the presentation, we do spend a lot of time thinking about our merchant power price exposure. So what we have here on the left-hand side is the calendar year 2021. You can see that relatively small amount of merchant power price exposure in the top left-hand corner. And then on the right-hand side, you can see that over half of the revenues of the portfolio in a year, 10 years ahead of us, it is fixed. And then you've got a little under half that is exposed to merchant power price. So that gives you a feel for the very long-term exposure. Why is there a difference between the long-term exposure and the short-term exposure? That is to do with our ability to fix power prices into the future. We can do that about 5 years ahead in the Nordic region, and we can do that about 3 years ahead in the UK. That's it for me for a while. I'll hand over to Tom Moore now, and he'll take you through the next few slides.
Thanks, Tom. Afternoon, everyone. Our investment activity has been underpinned by our approach to sustainability for a long time now. Sustainability considerations are woven right the way through our investment process. That starts at the investment screening stage, right through the transactional work, and then through to the operational and ultimate decommissioning or exit of individual investments. Projects that we undertake from early stage include our carbon life cycle studies, quantifying the impact that climate change may have on our investments, and our procurement policies all help support a more rounded investment. We have an in-house asset management team of around 19 people. We've built up specifically over a few years ago. That lets us get really close to the underlying assets. We see huge amounts of data coming from that portfolio, and it really lets us understand how they are working on a day-to-day basis. That lets us spot problems, but also opportunities very quickly. Some of those fall into some of the numbers that you've seen on this slide here. We really do see a great responsibility in the land and the waterways we manage, and we work very closely with local stakeholders, be it local residents, schools, charities, educational groups, to make sure we're really managing those assets and really maximising the impact they're having on the local environment around them. The next few slides cover the NAV performance that we've seen, and a lot more detail that we went into during the interim accounts, which we've recently published. This bridge chart here sets out the drivers behind the movement of the launch NAV and effective 98 pence to the NAV as the 30th of June. That was 100.2 pence per share. The 5 steps on the right hand side here set out the movements of the underlying investment valuations, and you'll see the 2 larger green columns there being the outperformance of the portfolio, having a positive impact on NAV, and also an increase in the long-term power price forecast we get from our advisors. Tom mentioned it earlier, but that performance today helped us and the directors bring forward that dividend guidance and puts us in a really good position for that dividend going forward. We have split out on the next couple of slides that same movement per the individual investments. This one here being the hydro portfolio. Really strong electricity generation through the first half of the year, supported heavily by high power prices, and also good cost control meant that EBITDA and cash generation was incredibly strong. We've also seen an increase in the long-term power price forecast from our advisors, which through our hedging activities meant we could lock some of that in as well. The reservoir and storage capabilities we have on this portfolio really came into their own during this period. We were better able to control that dispatch of that water to make sure we were making the most of those short-term power price forecasts we were seeing in the market. There's a very similar story here on the solar portfolio. Strong generation, higher than expected, coming through with higher revenues and higher operating profit, resulting in higher cash flows. Again, an increase in the UK power price forecast we've seen here. Worth just highlighting that third bullet point there. We're currently using an assumption of 25 years for a useful economic life of our ground mount assets. There's currently a process underway to enhance our planning rights and our land rights, ultimately to bring through the value of enhanced asset life and longer longevity for those underlying assets. The interims hold much more information on the sensitivities to various movements, but what most of our investors are interested in are the discount rates. We published those for the first time during the interims, and these are the discount rates we apply to our investment valuations. We published a range of 5.5 to 7.5% across that portfolio. Both ends of that range, in fact, relate to the UK solar assets, the lower end of that being an unlevered ground mount asset, the higher end of that range being our levered solar portfolio. And we've also published a weighted average discount rate of 7.3% that we use across the entire portfolio. I'm going to pass over to Henrik now, who's going to go into a bit more detail on the capital structuring and debt activity across the company.
Thanks, Tom. So firstly, we will touch on the debt position for the fund. So DOR has borrowing of just over 30% of the gross asset value. All of this debt sits in the solar portfolio, totals about £80 million. Downing Hydro, that was acquired unlevered, and that was done in order to avoid cash drag. We are pleased to say that we are well progressed on concluding a medium to long-term non-recourse debt package for Downing Hydro. That will do two things for us. Firstly, it will release cash for reinvestments for the fund. And secondly, it will establish CapEx facilities for Downing Hydro as well to make sure it can maintain all its assets in the medium to long term. We expect this refinancing to be concluded in the second half of this year. At the fund level, we look to complete a revolving credit facility also in the second half of the fourth quarter of this year. What that will do is to make up to about £25 million available for acquisition purposes. If we move on, we go to the pipeline. I think we are pleased to say that we see a very significant deal flow at the moment, both here in the UK as well as in the Nordic region. Also pleasing is that this pipeline is spread across all the different technologies that the fund has a mandate to invest in. As we've set out on this slide, there are several £billion of deals out there, and that's a bit academic in the sense that we'll only do a fraction of these deals. And what we're focusing on is acquisitions which are value enhancing and transactions which provide us with further diversification benefits. If we move on to the next slide here, we have some of the specific opportunities that we're currently considering. Firstly, we have two hydro transactions. That the two different portfolios that are up for sale here that we have exclusivity signed on. The first one is a portfolio of 11 operational hydropower plants, and the second one is 5. Both of these ones are located in central Sweden, predominantly the SC3 region, with some of the smaller facilities in the SC2 region. There's a good geographical footprint of these ones being close to the existing assets, which means it's helpful from an operational and O&M perspective, whilst not exactly always being in the same river means we get some further diversification to the different river flows. When you add these two hydro portfolios up together, we have a total estimated annual average production of around 34 gigawatt hours. On the bottom of this slide here, we have two wind farm opportunities. The first one is in Finland. It's a 30 megawatt onshore installation. This one is currently in construction. This is a bilateral transaction that we have. The proposed transaction structure here is that the fund would acquire this wind farm at the commencement of operations, so post the completion of the construction. And the strategy here is also based on the SPV that we ultimately acquire, having a long-term power purchase agreement in place at the point of acquisition. The next opportunity on this slide is a Swedish wind farm. We've covered that one a bit more on the next slide here, so I'll move over to that. This is the Lake Vänern wind farm project, where we signed an exclusivity agreement with the developer of this project earlier in the year. It's a wind farm to be constructed on Sweden's largest lake, so it's a shallow water nearshore opportunity. This would be the second wind farm on the lake. The estimated annual power production is up to circa 350 gigawatt hours. The structure of this transaction is that we would own 40% of the project. The sister fund Bagnell would own 40% of the project as well, and Clydeberry, as the developer, would retain 20%. This is a project that's currently ongoing, and we are going through the procurement phase, and we will provide a further update on this project once we have concluded that procurement phase. If we move on to the next slide, this sets out a multi-utility opportunity that we have been progressing throughout the course of this year. It's a possible acquisition of a company called Edsbyn. What does this multi-utility do? It does predominantly two things. It's got hydro assets, and it's got a local electricity distribution network. The combined bid we have for this that's been communicated is in excess of 25 million pounds in terms of enterprise value. What does it mean with an electricity distribution network? Well, that's a regulated business. It means its revenues do not have any link to power prices, and you have a monopoly in the region that you're serving. You provide the infrastructure for the electricity provision, so you don't take any direct electricity price risk here. The process is ongoing with the company. There are also other bidders that have shown up and shown interest in this company. I think it's not the right forum to exactly elaborate where we will end up with this. But I think what we can say is that we will always be very careful with the fund's money, and we will only make investments that make financial sense. With that, I hand back over to Tom Williams to take you through the summary.
Yeah, thanks, Henrik. So if we just then try and recap on what we've discussed, we have invested the money that we raised from IPO more rapidly than we had initially thought. The money has been invested in assets that have done better than we expected. The NAV has grown as a result. We've paid dividends, and that dividend guidance has been increased as a result as well. We do have a very strong pipeline. Henrik's talked you through that in quite some detail. And we are looking for additional capital in order to be able to invest in some of that pipeline. We do have some additional dates here for you. So the key one being Wednesday, so in a couple of days' time. I think that's the close for the fundraising. We would love it if people here who are listening will be excited and want to participate, and we'll very happily take questions from here.
That's great. Thank you to Tom, and Henrik for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with the published Q&A, can be accessed via your Investor Meet Company dashboard. I'd also like to remind you that feedback is important to the company, and immediately after this presentation has ended, we'll redirect you for the opportunity to provide feedback in order that the company can better understand your views and expectations. Guys, the investors have been able to submit questions. If I could turn back to you, if I may. I know I haven't given you a lot of time, but if I could ask you to read out the question and give a response where it's appropriate to do so, and then I'll pick up from you at the end.
Yeah, no problem. So why don't I take a few of these here. So the first one is a really good one, actually. There has been mention in the press that the wind hasn't blown recently in the UK, and that this has contributed to the energy pricing difficulties that we are aware of. What investigation is undertaken to assess the amount of wind that can be expected for any wind asset being considered? So lots of good points in that, I think. So first of all, what do we do? Well, what we do is we have a technical expert. They are independent technical consultants prepare what we call a yield study, which is a very detailed examination of the site, the natural resource at the site, the components that constitute, in this case, a wind farm, but it could be a hydropower plant or a solar park, and then produce a yield study which forecasts the generation of the site on a long-term average basis. And quite often what they do is they look at if there are nearby sites or nearby meteorological stations, they'll look at long historic data sets, look at measurements on the site, and try and compare the two to predict what will happen in the future. So it's quite a detailed process. It's quite exacting. What it does is it produces a forecast which is an average. So it's what we call P50. So it's the probability, 50% probability of a yield in any given year over the long term. So what that means is there's a 50% chance that you'll be above it and a 50% chance that you'll be below it. But over the long term, you will average out to that long-term average. So why are we as a fund saying that you need to be diversified? Why are we saying that natural resources are intermittent and variable? It's because of this. So yes, the UK has had a relatively poor wind year this year. That happens. The previous year was a relatively good wind year. So you will have good and bad years. What you want to do is be diversified across a number of different natural resources, so that when one wind year, when one resource, let's call it wind, is having a bad year, the other ones aren't. And why do we think that? Because we've done a lot of analysis showing the correlation between the generation of wind and solar assets, wind and hydro assets. And so the concept is that if we invest in those different technologies and one is having a bad year, then hopefully the others will not be having that bad year, and you'll be able to have that smooth, consistent returns in the fund. That's what we're trying to do. There's a very straightforward question here. What's the current gearing level? It's just a touch above 30%. I think Henrik touched on that in his slide. There's a question here around how full are the reservoirs in Sweden? That's a good question. Do you want to take that one, Henrik?
Yes. So the reservoirs at the moment are actually filling up, or been filling up during the course of October here, or during end of September and early October, which of course they always do. But they have been filling up rather quickly. They always fill up in the autumn. So I think they are at relatively good levels for us. At the moment, we also been, like anyone in this region, have been producing a lot, because there has just been a lot of rainwater as well, which generally feeds into the rivers. So right now things are good in terms of the actual production for the hydro.
We've also had a question here. It's quite a long question, so I won't read out all of it. But the thrust of it is that you can buy Door shares at the moment at not the same price, but only I think at the moment, I'm looking at the screens, and it's about a penny more at the moment. So you could buy Door shares for 1p more than this offer price on your usual platform. Why would you why would you go through a third party? I think the answer to that is because it's a penny cheaper. So that would only be £100 on 10,000, but I guess it's still £100. So but if you don't feel that that's a big enough difference, then please do go onto your usual platform and support the shares. We'd be really delighted with that too. We've also had a question saying, how many shares do Downing Partners own, and how many shares are we going to be buying in this IPO? Well, we Downing have supported the door in some size. So we have quite significant shareholdings across the individual people. It's not just within Downing Partners, it's also Downing staff who've participated. I don't have an exact number for you, but it's a considerable number, and also across the broader capital that Downing manages, there's also a significant shareholding in Door as well. So I think it's very, very well supported by the business. There's one more here. How do you plan to fund investments in the future, given that this raise is 25 million, but you have a pipeline of more than 4 billion? Yeah, look, that's a very good question. So there are two competing factors when thinking about raising money. The first is we do have a lot of opportunities out there, so there is a temptation to raise more. The second is that we have just brought forward our dividend. We're really proud of having been able to pay people a larger dividend sooner, which is pretty unusual. And so we were keen to raise an amount that was appropriate in order to be able to make investments, maintain that dividend for people, and then perhaps come back again in the future, maybe next year at some point, to if we were to invest the proceeds of this raise. What Henrik was also outlining around the capital structuring, and that was why we sort of wanted to talk to you about that, was that we have the RCF, so the revolving credit facility, which will give us an additional 25 to spend. We have some money left in the fund. I think it's about 18 million or so. So we've still got that to spend, and we have an ability to raise some debt within the Hydro portfolio as well. So there's a few things there that we can do with what we've got to try and invest that capital, and we thought that would keep us going along with this raise here for a little bit of time. And then the last reason for it was one really about cost. We're very conscious of cost for our shareholders. This issuing of 25 million was something that's already authorized by at the time of the IPO, and so we didn't need to go to the cost and expense of redoing the prospectus. We could simply come back to the market as we were. So that was also a factor in this too.
Tom,
I'm not sure it's a question, but we've got someone saying very pleased with progress so far, thanks. And he has asked a lot of very difficult questions beforehand, so we'll take that question.
Thank you very much.
I think
indeed,
that's
Tom.
pretty much it at the moment.
Thank you very much indeed, Tom. Ladies and gentlemen, thank you very much indeed. I think that, Tom, that pretty much concludes all the questions that have come in from investors. So perhaps before handing back, I could ask you for a few closing comments.
Yeah. So, look, when we set out at the IPO, we thought it was going to take us about a year to invest the money. We thought it would take us until next year to start paying a 5p dividend. And what we find ourselves in, the situation we find ourselves in today, is that we managed to invest that money faster. Those assets have done better than we expected. We've been able to bring that dividend forward. We really think that the differentiated strategy that we've tried to outline to you has really worked. It's really come into effect. You can see it in the results that we're portraying, and we would really like your support to grow this fund and hopefully do as well in the future as we've done over the last 6 months. No promises, but we'll try our best.